Hello and welcome to Options Guy TV 2026. All right. Well, we had our first show on Friday of the new year, or I should say our first trading session of the new year on Friday. And we looked at doing a zero DTE butterfly once again, and it worked out. So we had very good success just doing some short-term trades over the holiday period. Now we're getting into the new year, and I'm actually going to pull up the Tradier Pro paper trading platform. And I have attempted this before where I was buying some deep in the money option contracts as opposed to buying the stock outright. So I'm going to take that approach. I'm going to put it inside the paper trading account. Now, I'll be blunt in that I did a paper trade, and we had the stock that was doing extremely well was Nvidia, and the stock split. And when that happened inside the paper trading portfolio, the options needed to expire before you could close them. So that is a possibility. I'm also going to keep track of the positions on an Excel spreadsheet. And we're going to just try to do a little bit more longer term trading inside my book, the Options Playbook. If you go to optionsplaybook.com and you type in the strategy Fig Leaf, which is a strategy that I named inside the book, otherwise known as a leveraged covered call. But we actually had a viable reason behind it, and the community at the brokerage firm that I was at kind of helped me name it. And it's mainly because you're kind of covered when you look at doing a fig leaf. What you're doing is you're buying a deep in the money option contract as a substitute for owning the stock. And then you're going to sell short-term calls against the position. Now, I don't just routinely sell short-term calls because I don't want the volatility of earnings. I don't want to get pegged on the position. And the reason why is that you're kind of covered. And that's hence the name the fig leaf, in that you have the right to buy the stock, but you don't want to buy the stock. You're trying to just bring in premium to help pay for the time premium that is inside the option contract. So we're going to look at going out 6 months. We're going to look at a June option. We're going to start with Nvidia. Once again, Nvidia, still a solid valuation at this point in time. The stock has actually kind of been in a little bit of a choppy area ever since they had a great earnings report last quarter. And still, obviously a lot of people still talk about the valuation. Where's AI going? Who's going to be the winner? Are they going to have competition? Are they not? Are they selling in China? Are they not? All of this is happening at this moment. I don't mind using options as an alternative to buying the stock outright. Now, I've done this before where I've had stock and I wanted to own more stock, and it didn't have the cash to buy the stock outright. So sometimes you can use this strategy to add on to a position that you might be bullish on. You always want to be cognizant of being diversified inside a large portfolio, let's say $1 million portfolio or so. We'll look at probably the paper trading account actually has it started at 100,000, and all of those positions have wiped out of the account of my initial paper trade account that I set up at Tradier Pro. And we're now showing about $236,000. So that portfolio doubled in the time that it was there, which makes a lot of sense because if you think about it, we were like long Nvidia, Caterpillar, like the stocks that were really moving at that time. So I'm going to just keep that amount in the portfolio. I don't know how I would go out and just wipe it out and bring it back down to $100,000. So let's go to the Tradier Pro software real quick, and this is the paper trading portfolio, and it's exactly like the real portfolio. It's really nice, honestly. If you want to get a handle on Tradier Pro and some of the things that are behind it, you can open up a paper trading account with nothing and just try things out. But this is the chart on Nvidia, and this is exactly the chop that we're talking about. Let me go out 1,000 days here on the chart. And we're going to zoom in this little area. Oops. Let's go back one more time. And so we see the 200-day, and this is what I mean about the chop. You could be a little nervous about a head and shoulders that's happening right here on the way up, on the way down, but we're hanging in here above. We still got our ducks in a row, which the stock has shown some weakness, but by saying ducks in a row, we got the the 20 days turning up, but we're still well above the 200-day. The 50-day is acting as an area of support right now, and we got the 20-day just below that. So this was actually a crossover on the 20-day. It didn't really hang very well back here and came back, and now we're kind of making that up move again. Ideally, we would want all three of these to be in a row to kind of show that we're doing fairly well. But this is a little bit of a head and shoulders pattern that would break to the downside. That does make me a little nervous. But we're going to do this trade. We're going to go deep in the money, and we're going to go out to the June expiration. And we're going to go out about 150 days or so. 164 days is what it is. And so let's paint this picture. Let's paint this scenario. We're going to, if you have NVIDIA, or let's say you have a smaller portfolio, and I went, $100,000 or so, and that isn't. But let me put it this way: if you're buying 100 shares of $190 stock, that would be a big part of a $100,000 portfolio, right? So let's say you wanted to do the Meg 7. You wanted to buy all the stocks that are in the Meg 7 index, the Magnificent 7, that is on CNBC, and they talk about there's an index that actually tracks it, and there are some funds that actually track it, some ETFs. So with that said, if that is the case, how could we use a $100,000 portfolio and actually participate in those stocks? We can't buy 100 shares of all of them because they're expensive stocks. In comes the deep in the money call option as an alternative. Now, the more expensive the stock, the more expensive an option contract is going to be. So like Goldman Sachs is a much more expensive stock, and Goldman Sachs has been a staple in the portfolio, and now we're almost up to $1,000. Wow, up $42 today, up 5%, solid move. And a lot of the financial stocks are doing this, been long financials for quite some time, honestly. But the deal-making stocks, Goldman Sachs, JP Morgan, I think they're going to have really good quarters. We're seeing the yield curve being more favorable for the financial companies. The short-term rates are going down, the longer-term rates are going up. And that's always a good scenario for banks. And banks are getting rewarded, not only the deal-making stocks like Goldman Sachs, JP Morgan, investment banking firms, but even Charles Schwab, and just across the board. Okay, so here we are. Let's buy this option contract. I'd like to do Goldman, but it's too expensive to even buy one option contract, right? And I guess that's what the moral to my story was, is that even in the option trading world, sometimes you get stocks that are really expensive, and that's going to affect a smaller portfolio where you're trying to allocate a certain amount of capital. So here we are, we're at 190. Our whole goal is to get something that will act like the stock. So I'm literally going to scroll down. We're going to go at 164 days, about half a year, and we're going to look for an 80 delta. And we want to be really close. We don't want 76, 75 is not good. We want an 80 delta option contract. So the two that we're looking at are between the 80, 55. So it's a little bit more than 80. A little less is 79.46. But what I like is this option contract because I'm showing the open interest at 10,000. And here is the hardest thing in trading these option contracts. And honestly, if the markets were as tight as the at the money options, on these more expensive deep in the money options, I don't know if I would ever trade stock because this is a solid strategy to do, even though you got to pay some time premium. But the biggest issue is trying to deal with the bid ask spreads because as they get more and more expensive, the bid ask spreads will widen. And here we're okay. This, even though it doesn't, you might not feel okay if you're trading at the money options, but this isn't a bad market. 42.60 by 42.05. We got a 55-cent wide market. We'll try to work it a little bit, but it's big to look at open interest. And so this determines to me if I want to do the 79 delta or the 78. If the all the open interest was on the 79, I would rather do that option contract. Now, open interest doesn't necessarily mean liquidity. It doesn't mean that that's going to be the tightest market on all of the option contracts, just the way the markets work. But it means you have the potential to be the tightest market in that there are open interest literally can be described as you have more people interested in that option contract, in that if you're buying an option contract and you're selling it, if you buy an option contract, someone else has to sell it. So open interest is basically double. There's somebody on the buy side and there's somebody on the sell side. And options are literally contracts. If nobody ever trades an option and open interest is zero, it really kind of ceases to exist. It's that old, if a tree falls in the wood, nobody hears it, does it really fall? That type of thing. So that is the way I look at open interest. If you can get it, there's no benefit, there's no detriment to doing it. You might as well try to get markets a little bit tighter by just chasing open interest. Okay, it doesn't mean it's bullish. It doesn't mean that this option contract is going to go up because it has more. It just means that there's more people that have this option contract in their portfolio, and or at least there's more positions. It could be just one person, but ideally there's more people that are interested because there's more contracts that have been open. All right, 42 by 46. We're going to click on this, and we're in a paper trading portfolio. So I basically have to hit the ask. Now, if I'm doing this in my own account, I'm probably going to work it a little bit. I would start right about 10 o'clock, see where the market's at, work it, see if I can get a little bit of a shave a little bit off of the bid ask spread. But it's a paper trading account, so you don't have people on the other side, right? So the trades, you got to pay the ask. It's just that straightforward. And so if I look at buying one option contract, if I bought 100 shares of NVIDIA, that would be $19,000. So if we're trying to get a $100,000 portfolio, we're trying to get 5 or 6 stocks in there. You're looking at buying one contract. And if you need to stay diversified, that's kind of the way you got to do it. You got to look at, I want to allocate, it would be $19,000 to buy 100 shares outright. If I buy this now, we're paying $42.60. So it's a real option contract, right? So that's $4,260. 4,260 divided by 19,000. You're looking at 22% of the actual stock price. Okay. So the maximum we can lose is 22%. Could you lose more than 22% if you had 100 shares of NVIDIA? Of course you could, especially in an AI stock with that volatility. But we have the option that we can close it. We can get out of the position. So my goal whenever I'm doing a trade like this is really not to lose more than 10% on any one stock. And you can do that by, for example, there's kind of a hard rule that I have is that if the underlying stock reaches your strike price, that you're going to get out, or you could just say if it gets cut in half. But there's a way to kind of look at it to see what happens if the market moves against you. Okay. And that this is an at the money option contract right now, right? The 190 with 164 days remaining is trading for $24. If we go down and look at our option contract that we were looking at, let's go and scroll up a little bit. Okay. The 160, well, that's trading for $42. So if we bought this option and we're unlucky enough that the market tanked $30 from 190 down to 160, this would be an at the money option contract. What's the at the money option contract trading for? 24. Now, as expiration approaches, that number is not going to be 24 anymore, right? You're going to have some time decay in there. You're going to have some other issues. There's an earnings report that's going to happen before we get to the June expiration. But bottom line is that if you do this trade, you got a chance to get out. And on the downside, I don't want it to go much below the 160 before I would get out. And if it ran to 160 right now, we could probably sell it for about $25. Once again, you could just say, well, I'm going to get out if this goes to half, but you want to have a realistic expectation that this underlying would probably have to move at least 30 points for that to happen. We're going to start with almost 80 delta, 78.85, mainly because we're looking at the open interest, and we're putting up about 22% of the stock price to buy it outright. Now, I'm looking at this also. I'm looking at it as an alternative to buying the stock. So if I was thinking I was going to buy NVIDIA 100 shares, I'm going to buy one option. And maybe I buy two options if I get a little frisky, but I'm not going to take the $19,000 to buy 100 shares of NVIDIA and buy as many options as I can. That is using option as leverage. Now, that is where options are 100% risky because you're taking all the money you would have invested in the stock, where you got a slim chance of losing it all, and you're putting it in an asset that you could lose it all. So that is the goal. This is the way. This is the way that we're investing in NVIDIA. We're going to look at a couple other Meg 7 stocks. We'll try to mix in a couple industrials. We'll probably look at a couple of financials for sure. And then lastly, what's the one? Healthcare. That's another sector that I want to look at. So we're going to start by just doing the NVIDIA trade. Stock's at 42.60. Let's actually, it's right here. So it's up a nickel on the ask. We're just going to hit send. Okay, so we'll see if this fills. All right. Once again, it's a paper trading account. So if you are trying out the Tradier Pro software, you legitly got a paper trading order in. Now, the market did move, unfortunately, and your order does not get represented like it normally would. If you sent this to the trading floor, the ask right now would be the bid would be 42.60. You would see the bid come up because if someone came in to sell, you would be willing to buy at 42.60. The market's only willing to give you 42.25. So that's the difference between a paper trading account and a real live account. You get representation in the marketplace. So that's what I mean by sometimes we just have to just fill it. It's at 42.60. I'll leave it there for a minute. Here's the orders tab, and you can see that tab in here. I'll try to cancel and execute it before we get too far along, but that's the way I'm going to look at the portfolio. And then our portfolio is going to show up here. So we will look at the positions. The downside of the platform, and it might have got fixed. I'm seeing derived value. Let's see if we get if we put in VIX here. Let's check this out. Yeah, we're getting the option contract. So we might even be able to trade some of the butterflies in here. We could actually toss these in here now. And it's mainly because the derived value quotes and the SPX. You used to not be able to get SPX quotes and VIX quotes. That wasn't an option before. Now we can. Interesting. All right. Let's go back. Orders. Let's just fill it. Okay, so we need to 95. Man, I'm sad to have to pay that much. Okay, and open filled one at so it should be in our portfolio now. All right, so we're showing our NVIDIA 160 call option, 164 days to expiration, one contract. We're going to be negative P&L because of the bid-ask spread. We had to pay up to get it filled before the end of the show, $42.95, so $4,295. I wouldn't want to pay that much of a bid-ask spread. Market is moving that direction, though. It's not that bad. If I was really working this order right now, I'm looking down at the bottom of the screen, 42.70 and 42.95. I'd probably come in between those two prices. Very hard to fill at the midpoint on these deep in the money options. So I'm probably looking at 42.80. That's where I'm going to probably start at, trying to execute this order and see if you can get it filled. Like I said, you will see the bid ask move in the real markets. If you make an offer out there and no market maker takes it on the initial offering, they will represent your order and you will be able to see it. And then I would work that trade. Now, I don't want to sell a call against the position, and very rarely would I do that, in that you just buy a deep in the money option contract and sell a call instantly against it, because we still think the markets could go up. Now, where I want to sell calls is when we get a fairly decent run up, and we'll sell a call as a hedge to try to bring in some premium to help pay for the time premium that's in the option contract. We might not ever sell it because you just want to make sure you don't get pegged on that position. That trade would be considered a diagonal trade. You can sell a shorter term call against it, but we will do that as we add and build our portfolio. So at this point in time, we're long one of the 160 call options. If the stock runs up and the delta gets to 1, take the profits, roll up, and buy another $80 option contract. And that's always going to be our approach. If the market goes down, if it hits the strike, we're going to get out. Or you could say, if we're down 50% on the position, we're going to get out. Normally, if we're going out about half a year and we're buying an 80 delta option contract, that usually means you're putting up about 20 to 25% of the stock price. And that's just from doing this for quite some time. That's normally the case. If you go up further in time, obviously you got to put up a little bit more of the stock price. And that's just kind of how it works. All right, that's it. Well, I'll see if there's any questions. And Happy New Year to you too, Kurt, and everyone. But we're going to filter this in. We'll still do day trades. We'll still look at some earnings reports. But I'm going to keep this portfolio up and running. I think it's awesome that we actually could look at some VIX trades now, or even SPX trades inside the paper trade portfolio. And there it is. Thanks for coming, everyone. Happy New Year. See you this Wednesday for the next edition. Once again, live back in my hometown location right now. And we'll be doing that on Wednesday too, 11 a.m. Eastern time. Don't forget to set your calendars and watch the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.